Welcome to Channel 17, the Town of Colonie Government Channel.
Welcome to The Money Factor, our program that focuses on local business and personal finance topics. I'm Richard Naylor, your host. Investing for the future is vital, but the options are sometimes overwhelming. Our guest today is Frank Marchesini from Edward Jones, who will talk to us a little bit about investing, give us some principles from their company, and we can ask some questions that seem pertinent to the topic. Welcome to the show, Frank.
Thank you, Richard. It's a pleasure to be here today.
It's great you could make it. Maybe we could start and just get a little background, how you got to Edward Jones.
Sure. Just a little background on me. I'm born and raised in Colonie, married for 20 years, my wife Debbie. I have two kids, Matthew and Amanda. We're residents of Loudonville. Professionally, I worked 22 years in the manufacturing arena. And the two previous manufacturers that I worked for locally here had closed their operations, and we were faced with either relocating or finding another type of career path locally. So I chose Edward Jones. I wanted to find something where I could make a difference in the community, help people, build my own business, and so Edward Jones was a great choice for me. And my father-in-law was an Edward Jones broker back in the Midwest, so the decision was very easy for me, and that was about 2.5 years ago.
Fantastic. I was looking at the website, the Edward Jones website, and noticed that one of the things they were talking about, and we've all heard this in various forms, but the average person, it said, has only $25,000 saved for retirement. Now, I shouldn't have said average, it's really median, which is
Right.
which is a more meaningful figure. It means half the people in the country really aren't the least bit prepared for retirement. So I don't know how many people that would actually come to you that were in that situation, but if one did, how would you maybe motivate them to move forward?
Well, that's a great question. What I've seen being out in the financial world is that our society right now is really one based on consumerism, spend money today, credit cards and debt, and while previous generations have been more of the savers. Also, kind of compounding the problem is the fact that most of the company benefits now of, a fixed pension or a company-sponsored plan, they're going by the wayside. So the problem is that people have to take action on their own, and the sooner they do that, the better off they are. And investing is very, very important, but it's not an urgent issue that people face with on a daily basis. So my job is to make sure that people understand the ramifications of not saving. People are living longer, and they're going to need more money to enjoy a retirement. So it is a concern of mine, and I can help somebody put together a program to help them reach their goals, but you can't solve 30 years of problems overnight, so the sooner you start, the better off you are.
We should probably deal with the person that starts too late at some point. Maybe we could do that right now.
Sure.
What would you do if you started facing up to this problem today and you were retiring in, say, 10, 15 years?
Well, it's never too late to start, but what you don't have is the luxury of a lot of time then to have your investments grow properly, and time is really the most important component in investing. The compounding of your money, you've missed out on years that you can't make up for, but it is never too late. It really, folks in their 50s and 60s still have several years to live, and I'd never say, I can't help anybody in that respect, but you're limited to what you can do.
I guess one thing they can do, which is not something that everybody might want to hear, is that they can work longer.
Well, certainly that helps, and a lot of folks are forced to work longer than they had anticipated to make ends meet. So my rule of thumb is, if you have any concern, talk to a financial advisor. That person will be able to customize a program or a plan that's suitable for you. But the longer you wait, the worse off you're going to be.
So in general, I guess now, and we could come back to that later if it seems appropriate, but in general, what kind of principles do you espouse, or does Edward Jones espouse, in terms of how do you approach investing?
Well, that's a great question. Our firm, we've been in business for 117 years. And we have an excellent track record. Our focus is on the long-term, serious long-term investor. Our investment philosophy is really based on three principles. First of all, you should have a long-term focus, okay? And we can get to what long-term means. Secondly, buy good quality investments. And last, use proper principles of diversification. And if you do those three things, the opportunity for success is much greater than if you were to stray away in any of those categories.
So I guess then the question that we kind of folded into that was, what is a long-term investment horizon?
That is, generally speaking, we look at long-term anywhere, say, 10 years and out. But long-term can mean different things to different people. But if you generally let your investments work anywhere from 8 to 10 years on out, that's enough time to allow the market's volatility to even itself out. But that, generally speaking, is what we consider long-term.
Now, long-term, say 10 years or more, an individual company may have some great prospects for 5 years, and maybe the market changes and then things don't look very good. Is there a smart way to rotate, or what kind of a principle could someone follow in terms of, yes, you can buy a good company, but how do you know when to sell a company?
Well, that's a great question. Companies, as you know, over time, companies that were great 50 years ago are no longer in business today. And that's one of the risks that is present when you invest in equities or individual stocks. If you owned a single company, your entire asset is riding on the fortunes of that one company. So that's where diversification comes in, because we never know. Companies that are doing very well right now, we're never certain that they're going to be performing well down the road. So the more you diversify or spread your eggs across many companies, that evens out. Even if one company has a problem, you're not seeing the effects of it on your portfolio.
And I suppose if you're working with a company and you're taking their recommendations, it's not a problem to have, say, 14 or 15 companies that you would be invested in.
Absolutely. In many cases, our clients, through the diversification, they own a part of several hundred, if not more, companies. So the idea is you're really spreading your risk across many different companies, and also geographically, companies based overseas, domestically, in different industries. You can never predict with certainty what type of companies will perform better in the marketplace and which ones won't. So if you diversify properly, that is the principle that we feel works best for our clients.
And I think the second principle was quality, by quality.
That's correct.
Of course,
by quality.
There's a relationship between buying having a long-term investment and quality. How do you know what a quality company is? Is it a company that has a big dividend? Is it a company that has a long track record? Is it a company that is a value company?
Well, actually, it's all of those. Our firm specifically, when it comes to researching companies, we limit our research to about 350 companies that we actively follow. And those companies meet a very strict criteria for longevity. They've been in business for a long time. They're generally leaders in their marketplace, best-of-breed companies. They pay dividends. Those are the kinds of companies that our clients like to own. Now, there are other firms out there that'll follow companies that are, smaller cap, newer companies in the marketplace. We just choose not to, as a rule, follow those because we like the established performance base in place first. So quality really is synonymous with blue chip, best of breed in our world.
And maybe that sounds a little bit like the Jack Welch formula, top 1 or 2 companies in a market?
That's a good analogy right there, yes.
Okay, the third thing was diversify. We talked about stocks. What about bonds? What about municipal bonds, say? What about other kinds of paper?
Well, diversification, we'll start at the basic component of there are different asset classes and really 2 different types. There's investments that you own that are equity-based, like a share of stock, and then there's investments that are more loan-based, IOU-based, like bonds. Okay? Investments serve different purposes. Some of them provide more, are income-driven. They provide higher income immediately, and others provide more potential for future growth. And then some do a combination of both. So what we do is we look at a client's life stage, how old they are, what their horizon is for retirement. We look at the risk tolerance, and based on a combination of factors, we can construct the right proportion of stocks, bonds, the type of growth stocks, growth and income that's suitable for the client. That's the customization. And everybody is different. So what might be a suitable investment for one person is definitely not going to be suitable for somebody else. And that's why you should work with an individual that can ascertain what would work best for you.
I'm kind of fascinated with the idea of risk tolerance or how much risk somebody wants to take, because I see that in a way, and tell me if you don't see it that way, as kind of the customer has to be responsible ultimately for what happens. You can't blame any brokerage because the market goes down. So we all have to be responsible and say, well, the world is not guaranteed that we're going to make this much money. So when I look at risk tolerance, I always wonder, well, what does that mean? Because I want to be smart, and let's say I should take risks. You see what I mean?
I understand, and that's a question that I deal with several times every day. Basically, investing is different from savings. Saving is taking money, putting it in almost a guaranteed environment in a bank. It's insured. You know what the return you're getting. It's used for liquid short-term needs, emergencies, paying bills. Investing is about incurring some level of managed risk in order to get a higher return for your money for the long run. Now, what level of risk is suitable? That depends on a lot of factors. Your prior investment experience, what are your needs? But the idea is that there's no such thing as a risk-free investment. And my job is to sit with my clients and really ascertain what we need to accomplish and then find the investment that provides the best return but also keeps their risk to a minimum. We're not looking for grand slams every year. We're trying to hit singles and doubles, but we need to do that in a prudent fashion.
Makes sense. If I were thinking about risk, I guess I would, and I thought of this when you were talking, it kind of spurred the thought. If I wanted to retire maybe really well, I want to be able to play golf, I want to have another house, and my occupation didn't provide that, my parents didn't provide that, the only chance I have is to make the money somehow.
That's right.
So in a way, the risk of not getting that is not the same as the risk of not having enough money to live comfortably. And we saw in the paper, I think a couple days ago, that women, baby boom women, are really at risk if the family breaks down. So how do you separate the risk of not having a dream with the risk of really not having enough?
Well, when I sit down with somebody and we look at assessing how much are they going to need for retirement, the first thing I try to do is have them visualize what does retirement mean to you? What are you doing? And based on that goal or vision, we can then look at is there enough assets in place, or are you growing your assets and contributing to your accounts at a rate that would support that? And I look for gaps, and that way we can identify sooner that there's problems. We talked about what happens if you start too late. The risk is that if you're trying to accomplish a certain goal by a certain day and you don't have enough assets in place, then in order to achieve that, you'd have to take on more risk. And that's a problem because people want the best of both worlds. They want to sleep at night, but they want higher than market returns. And you just can't you can't have it all in this business. There really isn't any there isn't any free lunch, so to speak. And discipline, time, quality, those things are what work in the long run.
And that builds a solid base. So I think I'm getting, let's separate risk from risky. In other words, like risk behavior. If you're doing something that is actually dangerous, that's not what we're talking about in terms of risk. When we talk about risk, we talk about, yes, it could go up or down, but we're not looking at betting $40,000 on 13 on the roulette wheel, because the chances are you don't have a very good chance.
Right, and risk isn't the same as speculation, if that's what you're getting at.
Something like that.
We're not talking about just mere speculation or gambling, but even things like CDs have a certain type of risk. It's called interest rate risk, and if you renew one-year CDs continually, interest rates change over time. 2.5 years ago, we were looking at getting 1% to 2% on CDs, and if you continue to roll CDs annually, you're subjecting yourself to what's called reinvestment risk. What is the rate going to be the next time you roll the CD? There are all kinds of risks out there. So one of the things that we have to consider is what kind of risk is suitable for the individual, and find the right product to meet the goal. And my clients have to understand what the risks are. There are no guarantees, so as long as I make sure that they understand the risk and they're comfortable with that, then that means to me it's a suitable investment and we should move forward.
Sounds good. Let's add into that a little bit inflation as a factor. We've all been Fed watching for a long time. We've got a new Federal Reserve chairman in Bernanke.
Right.
But it seems like things are pretty stable. There shouldn't be any fears that he's going to do something radically different. What strikes me as interesting this year is that I've started hearing people talk about lowering the rate. And it seems that some people are actually convinced that it will go down sometime in 2007. I know we don't want to speculate. It could stay the same. We could have inflation. It could go up. It could go down. But how do we think about such numbers? We get these government numbers all the time.
Well, that's an interesting question, because literally not a day goes by where someone I'm talking to asks me about where do you think interest rates are going to go. And our firm has a very clear stance that we're not in the business of predicting where interest rates are headed, because really nobody knows at the end of the day. What we try to do is look at, from an interest rate standpoint, how do we protect your investments so that no matter where interest rates go, your income and your principal, the value of your interest-sensitive investments, the impact is minimized no matter where interest rates go. And there are strategies that we can put in place to do that. So that's how we deal with it. We just, anytime you try to predict, you're going to get yourself into trouble. And we just choose not to take that approach.
It sounds parallel to what Microsoft did when they were deciding whether they should build Windows or maybe go into something else, CPM, or whether they should sell to IBM or whatever. And they had 6 different scenarios, and they were ready to follow any one of them, and certainly the most profitable turned out to be what happened, but it sounds a little bit like that. You want to have alternative routes so that whatever happens, you're really not caught off guard. Is that correct?
Yeah, that's a similar approach in that, again, diversification means many different things. It's not just, having multiple numbers of investments, but it's having the right kinds that will mitigate, no matter where rates go, the impact isn't as great as if you guessed wrong. And quite frankly, that's where our clients aren't looking for us to make predictions. They're looking for us to navigate through, no matter what happens, we've got a reasonable chance of success of reaching the goal.
I like that, a reasonable chance. No,
better than reasonable.
Yeah, no, but that sounds good. I mean, we do things in this society based on what is a reasonable thing to do.
Exactly.
That's exactly. Now, in terms of inflation and bonds, just to throw one thing in there, this can be confusing, I think, to a lot of people. I know a lot of people have figured it out, but when the interest rate drops, a lot of times bonds are more valuable because
Correct.
they were paying more. Does this fit into the planning process in terms of, should I buy a bond because maybe interest rates are going down, but I need to balance it with other investments?
Yes. Basically, interest rates are viewed two ways. There are short-term rates, which you hear the Federal Reserve raising or lowering the Fed funds rate. Those are controlling short-term rates, and that's the Federal Reserve's action to keep inflation in check. What folks tend to get confused about is they think that there's a direct, because short-term rates go up, long-term rates are going to go up commensurately, and that's not the case. Long-term rates are really a function of supply and demand for long-term bonds, and it's the market's view on what are inflation expectations in the long term. So all of the good work that the Federal Reserve has done to keep inflation in check, that's kept long-term bonds bond rates relatively flat. And we're seeing right now a phenomenon called a flat yield curve, where short-term rates are basically a little above long-term rates. But what happens is short-term rates move up and down quicker. So where today you might have, if you had all your money in short-term CDs and getting 5%, it's possible down the road that within 2 to 3 years you could be getting 2% on that money. So that's where the diversification comes in, and we educate our clients that there's a need to lock in some of your money on long-term rates, because if rates drop, then your income is more dependent on that change. So again, that's why we don't try to predict, because you just never know.
And that's why diversity is important.
Exactly.
Little bit of a parallel topic, but it's certainly an investment in many people's minds. Real estate. I know that's had a big impact on our economy in the last 10 years, and we're hoping it doesn't have too big of an impact in the next few years in the negative sense. But a lot of people have used their real estate as an investment. Are there dangers in that?
Well, I'm going to preface my comment that our firm is not in the real estate business, okay? But knowing that many of my clients have been very involved in real estate. Real estate is a different type of an asset. Just like you can invest in stocks and bonds, you can invest in real estate, and many people have done very well. And I would just caution people that just like stocks and bonds, everything has a cycle. Commodities, gold, you name it. You just need to be careful that if you have too much of your eggs in the real estate basket, at some point things cycle and you could be impacted. So I guess that's really all I can say about real estate. From an investment standpoint, there are real estate investment trusts that look at buying companies that are invested in commercial and commercial real estate.
Center or
Right. And I use those when it's appropriate with some of my clients. But going out and buying a house versus a a stock, that's a personal decision. If you need the house or you're going to actively manage that, that's something that I can't. I don't get involved in that recommendation myself.
Right. Well, I would see this as a somewhat risky, and that's only a personal opinion. I'm certainly not making any kind of a judgment, but people talk about flipping, and it just seems kind of a dangerous attitude to me to be putting a lot of money and turning houses over and thinking that that's an investment.
I know many people do it successfully. But again, I want to caution that sometimes people get in it too late. They follow, by the time everybody's doing it, it's too late.
Right.
You almost, just like you have to take a contrarian approach sometime.
Do you want to talk about, we're getting close to being out of time, and I want to leave you time to fill in anything you think I've missed. I know there's an emotional part of investing. Everybody comes to you with a different risk tolerance and also a fear of losing something. Does that play any part in how you would counsel people to think about their investment?
Emotion is probably the number one significant component in an individual's willingness to make an investment. And it's interesting in that many people feel that when the market's going down, they're not going to invest, and then when the market's going up, they're waiting for it to drop. So you really do. We don't try. Our principle is don't try to time the market, because if you do, in the long run, you won't be invested at the right times. We recommend it's how much time you're in the market, staying fully invested, not letting the short-term bad news cloud your long-term perspective. And it's difficult because everything you hear on the news, it tends to be bad news and a reason not to invest. But in the long run, that's what's going to make a difference, is putting money as you have it available in the right investments to meet your goals. That's what works.
That's just about a good place to leave it, I think, because we could go on in technical details of this and that, and IRAs and Roths, and should I do that and should I do this. But as you say, we don't really want to recommend anything. So it sounds like, to sum up, and I'll give you the last word though, the main thing is that you really give it enough time and thought and not put off doing something, because putting it off is really not going to get the job done.
Great point. And I guess I'll close with this point. There's probably, other than your family and your health, your retirement is the most important thing that down the road will impact your life. And if you're not sure what you should be doing, go seek out some financial advice. There are great people out there that will work with you, set up a plan. Contrary to popular belief, you don't have to have a lot of money to invest. You can invest systematically within your budget. So seek somebody out. Don't let another day go by. That's the rule of thumb and advice I could give anybody.
Thank you, Frank.
You're welcome. Thank you, Richard, for having me.
And I want to thank our viewers for watching, invite you to our next show, and hope you have a great week. Take care.
Welcome to Channel 17, the Town of Colonie Government Channel.